Good morning, everybody. Thanks very much for joining us. Really interesting session this morning, and we're going to be looking at infrastructure, but particularly also at new energy. So really interesting discussion that comes into both, I suppose, the real estate side and also the infrastructure side. So a really interesting area to cross over. Super panel here for you today as well. So we have Thomas Veith, who's leader of real estate and real assets for Germany at PwC. We've got Alejandro Ciruelos, who's managing director of Renewable Energy for Sustainable Development Capital. Sophia Truong, who's an energy lawyer at PwC Legal. Jim Wright, who's listed infrastructure fund manager for Premier Miton Investors, and Thomas van der Meij, who's senior portfolio manager for infrastructure at Kempen Capital Management. So really good set of speakers here to be able to give you some insights on the market. For those who don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media, and as well as producing a series of magazines and dailies, we also run around 60 of these events a year, and the idea is to bring together people in the market, discuss strategy, discuss market insights, and help share those insights with everybody. We're going to start off just with a couple of brief presentations. So, Thomas, just a brief presentation on, I suppose, some of the introductions to the market. Over to you, Thomas.
Yeah, thanks, Richard, and good morning also from my end. What I will do is just give some indication, some trends we see in the new energy market and what's driving that, and give some basis for our discussions later on. I just have to activate this clicker. I hope you can see the presentation. Yeah, let me start with the key fundamental drivers we see in the market. Now it tells me connection lost.
We can definitely see the slide there, though.
No, I'm back. I think now we have the key trends which are driving the transformation into new energy. And for the overview, one of the key topics, of course, is the need for decarbonization. I think we all are talking and feeling that the global response to the threat of climate change is impacting, I would say, all industry sectors, and especially I think it brings the biggest change for the energy systems for decades now. We see that the climate path agreed in Paris is driving more activities, investment into the especially energy sector, and the upcoming COP26 later this year in Glasgow will also give, I think, an additional significant push into the sector for further decarbonization, but also for quantifying what we can do, and new energy will be a significant driver behind that. The second thing is it's not just the government that are pushing into the trend to decarbonization. We're seeing more and more stakeholders are also requesting a change. It's from, let's say, the capital markets, the corporates, the users, the end users, the customers, the all clients, and also the employees are asking for change. I think that's one of the key drivers that brings also significant investments into the new energy sector. Of course, the second trend is the technological process. I think if you look at the old world of energy production, there's also a change. We have more and more sources for new renewable energy. We see new battery systems. We see that connected homes, smart homes are much more digital. And this all brings a more decentralized system of energy production into the new world, but also bringing smarter, cheaper, and cleaner tech up to the agenda, which was not the case decades ago when the current infrastructure that we see was set up in the energy sector. The third trend is the request for clean air policy. I think it's also a sector where energy has a significant impact. We see more inhabitants focusing on clean air, want to reduce air pollution. And one, I think, important step was the Air Pollution Action Plan from 2013 in China, pushing into the sector also driving significant investment into China, into new renewable energy, battery technology, and electric vehicle. And one additional advantage of the push was that these technologies were more and more and are more and more affordable for the wider group of people and end users, like I said, especially the electric vehicle in China, but that also gives a significant push around the globe, because I think the affordability is an important piece. It's nice to discuss new technologies, but if nobody really can afford it, or the prices for this energy we produce with the new technologies is not affordable, it doesn't make so much sense, and it will not give such a huge impact to the market which we need. The fourth trend, I would say, is the wider environmental concerns. Let's say it's about polluting the oceans, etc. And that's also one important sector where the energy sector can have a good and positive impact. I think the key word is energy from waste technologies, that we can avoid pollutions in the oceans by using this waste for the energy production. I think that's a key trend where we see several good investment opportunities and technologies evolving. And last but not least, the fourth or the fifth driver of changes in new energy is, of course, the aging infrastructure. If you look at the existing energy production, or the majority of energy production infrastructure, it was built decades ago. We see the coal, gas, nuclear plants set up in the, 60s, 70s, or even earlier, after the Second World War. And all these plants and technologies are coming to the end of their useful lifetime, and that's where also governments and a lot of stakeholders pushing for new technologies, new renewable infrastructure energy systems, which are also subsidized by loans and other subsidies, and also the demand for new renewable green energy is growing. So there's a good competition of, let's say, old infrastructure with new infrastructure. And of course, the key winner we see, also supported by subsidies, is of course the new, more decentralized energy production field, but that's something we will discuss later today. So these are I would say, the five drivers we see in the market. And what does it mean if you look at the old production style, the traditional energy production downstream from the production down to the customer? I think that will significantly change. As I said, we will see the new supply chain of energy production, with much more decentralized facets like batteries and etc. in the middle of that. As the production, especially from solar and wind energy, is not so stable over time, we have to see how we can store energy in between, and I think that's much more flexibility in the whole supply chain, but it also gives us a lot of investment opportunities. So what does this mean? I think it's a big change, it's a big transformation of the whole sector. Hundreds of billions of whatever currency you take, euro, dollar, pound, is needed to transform the sector. But also the old style, I would say, of investments and investment funds are changing. As I said, in the key trends, we see more technology enabled systems, energy production, a more decentralized production, where we simply have to involve new skills and new technology expertise into the sector. But that opens up different new investment opportunities, also for different risk-return profiles. As you can see in the chart, of course, there are some new venture capital style, I would say, investment opportunities where you can have investment returns like they are usually in venture capital, 20% plus. And then you have the growth area of investment opportunities in the energy sector, bringing returns 10 to 15% IRR, which is a classical private equity style investment like hydrogen advanced hydrogen, etc. And then you, of course, you have the bigger investments of mature technologies like wind, solar, that are more advanced, which are a good basis for the large infrastructure funds globally, focusing on the return profile. I would say 5 to 10%. Or even a bit lower if you compare that with the interest environment we currently see. So that's as I see, there are key trends. There are lots of opportunities coming up for every type of investor, but it's a big change also on the people side. As I said, more technology involved. More new skills are available and needed to do this transformation, but it's a good road, but there is a lot to do. And I think all investors in this field will have a bright future if you focus on the right trends and in the right opportunities. So that was my quick overview of trends and identifying specific opportunities. That's something where Thomas from Kempen will give us a quick overview how they do it in the US. Thank you.
Thanks, Thomas, and good morning all. So just to give a bit of background on what we do, I'm responsible for Kempen's listed infrastructure strategy. We invest globally in listed infrastructure companies offering a liquid solution to get exposure to the market. I think it's key, and that's what we believe at Kempen, is that the energy transition is one of the mega trends that we see in the infrastructure sector, which will result in a multi-decade secular growth story. There are plenty of opportunities, both in like renewables as well as in new energy. But for us, it's key to find the best opportunities out there. We have a fundamental bottom-up approach for that. We do that across the various sectors. So we invest in like transport infrastructure, communication infrastructure, but also the utility sector and renewables. It's key to use data to find the right opportunities. I just put out a slide here just to give an example of the data we're using. One is on the left-hand side, you see like sunshine, basically giving us an indication where in the US in this case, and what the best counties are in the US to build solar panels. However, the analysis doesn't stop here. I mean, we can invest in pure play renewables, PPA contracts, but you can also invest in vertically integrated utilities. For them, it's important to manage the customer bill. So if you want to make a rotation out of like fossil fuels into renewables, you also need to manage that bill. And what we see is that, and that's more the social aspect, if you would look at the ESG side. If you would look at the customer bill, it's key to keep that stable. And what is more, it tends to be the case that when the affordability is high, so the energy bill versus disposable income is low, the community is more willing to fund the energy transition. So this is a sort of data analysis that we use, that we go out for companies, but we do not only invest in pure play renewables as said. I think for us it is important that companies are committed to Paris, but they don't have to be there yet. So although carbon intensity can be high or above average today, as long as management has identified the opportunities to rotate out of fossil fuels into renewables, we're willing to like look forward and discuss that with the management teams on the ground. In addition, what we have identified, and I think that's important to also mention, is that it's not only about investing in renewables, it's important that the grid will be upgraded. I mean, electrification, in our view, actually today offers more attractive opportunities, as a lot of capital will be needed to manage the additional capacity and renewables on the grid. What is more, I think we're all aware of that it's key to commit to Paris and to limit global warming. However, we do see two types of stranded asset risks. I mean, one is commonly known, that is obviously investing in fossil fuels, especially coal, that it will become incrementally difficult to finance those assets, and cost of capital for those assets will most likely go up. We have taken the view that gas is going to be a transition fuel, so that's a slightly different story. Especially to balance the grid, it will be required as backup facility. I mean, we have seen incidents also with storms that, wind was not blowing for like a couple of days, Unfortunately, battery storage is not good enough to back up. So as soon as, I mean, there will be a lot of investments required to improve that. But until we're there, gas will be needed, and also hydrogen is going to be an interesting opportunity then. The other one is if the transition, the energy transition is not fast enough and global warming will actually exceed the 2 degrees scenario, the risk and the likelihood of stranded assets due to like natural disasters will increase dramatically. So the slide I'm showing here is we're able to map 23 different types of global disasters. The case here is wildfires. So with global warming, the likelihood of wildfires is going to go up. We're able to identify where the risks are and what kind of like actions are needed by management to either like harden the grid or protect our investments. I think we can leave it here as an introduction. Richard, I think back to you.
Great, thanks very much. Really interesting opening presentations there. Thanks very much, both Thomases, for that, and gives a lot of kind of fuel for discussion. Just a reminder to everybody, thanks very much for joining us in the RealX platform. On your right-hand side of your screen, you can add comments. You can also use the Q&A button, and we'll obviously be trying as much as we can to answer your questions. So please do put those questions and those comments in the chat, and we'll come to them. I thought I'd just start maybe with you, Jim, if that's okay. Just picking up on, I suppose, some of those topics, but in terms of the key drivers for the transition to new energy, what are you seeing? Just a brief introduction of yourself as well, and then your kind of views on, I suppose, the key drivers for the transition to new energy.
Yeah, sure. So, my name's Jim Wright. I run the listed infrastructure strategy for Premier Miton, which is a UK investment house. And I've been running listed infrastructure strategies for around about 16 years now. I think, I would echo a lot of what both Thomases have said. I think they're exactly right in what they've said. I think what we, the real key for me is the fact that there's two parallel drivers which are going to drive investment into new energy, into the energy transition assets that we need. One is policy, and we've now, having seen the new federal government in the United States is obviously a lot more constructive for tackling climate change than the previous regime. So we've now got pretty much a global consensus. Even China, even China are now serious about reducing carbon emissions, and some of the coal-fired plants that they were planning to build as part of their Belt and Road Initiative, they've put a line through. So we have this global policy consensus. But then in parallel, I think the other really important aspect is that renewable energy is getting cheaper, and I think you've got this economic driver as well. So when we look at the US, we look at 2020 versus 2019, there was a 12% growth in energy generated from wind and solar, even under that kind of hostile federal government. And the reason why, in many cases, is economics. Texas is the biggest state in the United States for renewable generation from wind and solar. That's not policy. That's economics. That's the availability of cheaper and cheaper electricity from wind and solar. So I think we've actually got a really constructive backdrop with these, with both drivers working in tandem, policy and economics.
That's interesting. And Sophia, maybe coming to you, just in terms of some of those trends, both from the market as well, what are you seeing there?
Yeah, hello from my side. Short introduction. I work as a lawyer for PwC Legal in Germany and in the energy and climate field. And what we do here together with my team is to advise energy suppliers and the housing company, municipal companies, and also energy intense industry in this very field, and supporting them in their transition And I can just underline what Jim said, because it's entirely true. There's one huge pressure coming from the regulatory side. And I just want to give an example. Therefore, we just saw in Germany, we have a decision from our Federal Constitutional Court overruling our climate law, telling that it's against the Constitution, sorry, because the future generations are not protected enough, and so the government is in need to change this law, and there are already drafts which are putting more and more pressure on the energy market, because the carbon dioxide budget, which is set by the Constitutional Court, is very much lower than the first draft of the law. And we have the draft of the climate law on the European side already as well. And the draft we have here now, I'm not very sure that Germany can sign this, considering the decision of the Constitutional Court, of our Constitutional Court. But it's not only Germany or European politics here. We see the different other European countries, the Netherlands, Ireland. There are court decisions. There are decisions supporting climate, and big companies, energy intense companies, some great emitters are tackled here a lot, and the people get through with that. I mean, and that's very interesting, because that's a very late change we see from the regulatory and also from the court decision side. And I think there will be many more will follow also in the other countries.
That's interesting. Thanks, Sophia. Maybe Alejandro, just coming to you, how would you characterize, I guess, the past 12 months during the pandemic, and has this had an influence on the market, investor intentions, more of an increased focus on your area?
Yeah, thank you, Richard. So by way of an introduction, my name is Alejandro Ciruelos. I'm a managing director with Sustainable Development Capital. We are a London-based independent investment manager and advisory house, exclusively focused in sustainability. We manage a number of funds, including our flagship publicly listed infrastructure fund called Veith, which was the first one listed in the London Stock Exchange, focused in energy efficiency and distributed generation. We have been investing in the sector for about 13 years, and I run the renewable energy division of the firm. So that's a bit of an introduction. And prior to Sustainable Development Capital, I was the head of infrastructure for Santander for about 15 years. So look, in terms of the last 12 months or 18 months since the pandemic broke, have been tremendously favorable to the overall sustainable and clean energy sector because of two reasons. First of all, it has proved to be tremendously resilient. So compared to other type of investments, whether it's on the corporate side or in the infrastructure side, the sector has performed very, very well. Clearly, energy demand has been negatively impacted by COVID, which obviously is intrinsically linked to GDP. But on the other hand, the headwinds have been sort of like counterbalanced by the amount of interest and investment in the whole topic of decarbonization. And basically borrowing on the topic from that Jim was mentioning, obviously regulation has been very positive, as most governments have seen in the transition into the new energy transition, a way of fostering the recovery of the overall economy. So whether it's the Green Recovery Plan from the EU or the UK or in the US, basically all of the governments around the world have signaled very strongly that they see a path forward, and that the clean energy sector or the new energy transition is one of the primary ways to get back on our feet and get our economies back on track. So that's one. And the other one So the resilience combined with the need of fostering that green recovery have basically heightened attention from, I will say, pretty much everyone. On the supply of capital, I think investors are now very, very acutely aware of, whether they invest in the green energy sector or they invest in, or they do the traditional investments in other sectors, any energy transition related themes, and also any risk attached to those investments. That's clearly become part of the day-to-day activity of most investors, most investment managers, but also in the way that corporates and issuers behave, in the sense that they know that they cannot carry on doing things the same way, and they're looking to decarbonize their day-to-day activities, and clearly there's again heightened attention to improvement in areas like supply chain, how they run their processes, even recruitment and many other areas. So the flywheel is now in full motion, so to speak. And I don't think there's been ever a better moment to invest in the sector. Having said that, obviously there are many risks, and the level of focus in the sector means that there are also investors that are not making the right decisions or focusing in their own assets, or probably there's too much capital chasing the same opportunities. So from where I sit from an investor point of view, we need to be selective, and I think those with a differentiated investment strategy that is very clearly articulated and they can measure well what the returns are on a risk-adjusted basis will continue to do well.
And that's interesting, because it's a similar story very much in the real estate side of the real assets as well. Jim, I just wanted to come to you in terms of some of those challenges there. What are you seeing, and I guess what's your view on that and the risk side?
No, it's a very good point, and certainly on the listed side, what we've seen with the equities we invest in over the past 6 months is some of the development stocks for renewables have come under some pressure, and that's a concern, reflecting exactly what Alejandro said of too much capital maybe chasing certain niche investments. The very obvious example would be the Crown leases that we saw in the UK, where very, very competitive bidding round from big oil companies as well as renewable developers, increasing the price paid and therefore putting pressure on returns. But I think we take a very kind of holistic view of this, and we think that actually, if we are going to come anywhere near meeting the climate change targets that are out there across various countries and states and the United Nations and so on, the investment into renewables is going to have to be huge, and there are plenty of opportunities out there. If you think of offshore wind, it's not now about the North Sea, it's about the northeastern coast of the United States, Virginia, Connecticut, New Jersey. It's about Taiwan, it's about Korea, it's about Japan, it's about potential floating offshore wind in California. The opportunities are huge. So actually we think investment has to be properly directed, but in fact, the opportunity for renewable generation and for the infrastructure that lies behind it, transmission, etc., storage, the opportunities are massive. So we're very, very constructive on the overall investment case for energy transition.
Okay, great. I've got a question coming in from Rui. Thanks very much for that, Rui. Which is, investors and funds will shift more and more to green financing smoothly, or will it be a faster movement? How do you think regulatory and incentives can support this shift? So I don't know whether anybody wants to pick that up in terms of the shift to more green financing, and the regulatory or incentive side to support that. Does anybody want to pick up on that point?
Yeah, well, I can comment from a German and EU perspective, and yes, there is a clear shift from institutional capital into greener investment. If you look at the EU taxonomy, it could be Article 8, could be Article 9, but as we have seen, one initial German fund with under Article 9 focusing on solar, and wind production in Europe. I think that's a clear trend. Investors are still not there to say, look, I'm happy to have X% less return for a green investment. I think that's also, we just published a study around that, more for real estate, but I think it's the same for infrastructure. And that's not the point. But if you include this ESG and decarbonization components into your business plan as a value driver, I think it's the returns tend to be higher than in the old style, I would say, investment opportunities and fields. And yes, I think EU and globally green investments are already supported, or financing initiatives by subsidies, by regulatory frameworks that clearly see the target to do something in the green environment. I think that's pretty clear. It's not really transparent, to be honest. That's our subsidy advisory colleagues have a lot to do currently, because there are so many pots of money popping up from local, global, national, EU level, global level, etc., where the transparency is pretty low. But there's a lot of investment capital out there, but also subsidies out there. And if you combine all these, I think it's a clear message from the stakeholders that green investments are pushed, and I personally think that's absolutely the right way.
Okay, great. Hopefully that answered the question. Thanks very much, Thomas. I just wanted to pick up from the Kempen point of view, I guess. Thomas, what are you seeing in terms of capital? Jim mentioned there more capital, so did Alejandro. Are you seeing this? And I suppose, is that beginning to adjust your investment outlook?
No, there's definitely more capital flowing into the sector. I mean, I think also with like Biden's infrastructure plan, there's a lot of attention for the sector as a whole, but especially also the renewable business. So we've seen strong capital inflows into ESG stocks last year. And that also, to be honest, for us was also the reason to reduce our exposure pure on valuation. We've taken a more like forward-looking approach. So a lot of like investors tend to focus on the current status of companies, sort of tick the box exercise. Are they green today? What's the ESG rating today? For us, and I think then we're getting back to the point on return and ESG, we believe it's a win-win situation, and both can go hand in hand. So it's not going left or going right. I mean, it's doing it together and going straight forward. Especially what you see with like more of like the vertically integrated utilities instead of the pure play ones. They have legacy assets. So for a lot of ESG investors, they're not interesting enough because they still are producing coal or using coal fired facilities or gas facilities. However, I mean, most of them are on the pathway to become sustainable. I think, and that's where we can make a difference. By investing or allocating our capital to pure play renewables, we're not going to help the world solely. I mean, we can make a bigger impact if we allocate capital to those companies that are on the pathway to become sustainable and are going to make a difference. You can think about companies that with an CO2 intensity that is actually too high today according to the EU taxonomy, but with like the closure of coal fired facilities over the next few years, that CO2 intensity will drop dramatically and actually become better than what is agreed on with Paris. If you take that into account, it's something. I mean, ultimately, we need to keep the lights on, right? We cannot like turn off like the electricity today. We need certain backup facilities. On top of that, what I said before in the intro, it's you have to manage like the energy bill to fund the transition. So instead of like solely focusing on the environmental side, it's important to also like consider the social side. Meaning that the energy bill needs to be like affordable for the community. But in addition, the impact of closing a coal facility is big for the local community. I mean, there are a lot of people working on a coal-fired facility. If you would replace that by wind and solar, the number of like employees you need there is going to be much lower, and you need different types of skills. So if companies have a plan there, basically phasing out the coal facilities, but also taking the social side into account, we think that is really important. And to make that point, we could invest in companies that sell their coal-fired facilities and replace them by wind, which would definitely help their CO2 footprint. However, it would not help the world because somebody else would still keep that facility running.
And Jim, what's your view on this? It's interesting because we've got a lot of capital being raised for impact ESG strategies. But do you agree in terms of investing both in those that are pure renewable, but also in some of those that are heading in the right direction?
Yeah, totally agree. Absolutely. And as investors, if we can kind of encourage companies to move more quickly at a faster trajectory in the right direction, I think that's exactly the right thing to do. I think also the other really important point is, we focused a lot on renewables, but actually, the energy generation sector is only a part of the solution to reducing carbon emissions. It comes down to transportation and facilitating electric vehicles. It comes down to buildings and increasing the energy efficiency of buildings, which is vitally important, and potentially replacing gas-fired boilers with electric heat pumps, or even maybe with hydrogen in the future. And I think all of this is something that as investors with capital to direct and with other people's capital to direct in the case of the listed fund managers, this is something that we can encourage and incentivize and support, and I think it's vitally important that we do that.
Great. I wanted to drill down a bit more into some of the forward-looking trends. So Alejandro, in terms of solar, wind, wave energy, are you seeing any major changes or shifts in terms of where we're heading?
I think the industry is at an inflection point, but I would like to pick up on or elaborate further on this point that Jim was just making. So power generation is only a portion of the overall picture. Obviously, so far it's been has been the quickest sector to decarbonize, but we have a big challenge on heat and transport as well. And I think the talk maybe 5 or 10 years ago is that there were a lot of people scratching their heads around how do we decarbonize heat and transport. Whereas what I see is going forward a very clear path. In the case of transport, through a combination of electric vehicles and hydrogen, that's whether it's like for light smaller vehicles, electric vehicles is definitely the way forward. Whereas for let's say heavy vehicles, that looks like hydrogen will be the solution. And 5 years ago, those were things that were very much not clear in terms of how they will develop. But now I think we have a lot more clarity in the way forward. So, for example, one of the investments in our listed infrastructure fund is into a business that provides EV charging points across the whole of the UK. Then the other area is obviously heat, which I think is also changing dramatically. And it's not so much about focusing on getting support from getting support in terms of how the sector has been traditionally funded for the last 10 or 15 years. In the case of heat, this is as much as demand reduction and making an efficiency around buildings. This is something that we know a lot about. And if you look at, for example, the EU recovery plan, the focus on buildings and reduction of overall energy demand in that sector is massive, and actually a lot larger than it is in the power generation sector. So I think those areas around energy efficiency and also in buildings, for example, having heat, renewable sources of heat, whether it's electric heat pumps, but also combined heat and power that is fueled by recyclable or renewable gas or biomass is definitely the way forward. So that's to me a very exciting area to be focusing on. On the traditional renewables end, I think clearly we are now moving towards a net zero emissions target by 2050, and we're moving from renewables being the residual marginal technology to being absolutely mainstream, and by 2050 probably like having a very high level of renewables penetration in the market. That obviously presents plenty of opportunity because the growth is going to be there. So I think from an investment point of view and in an inflationary environment, I think there's been a bit of a shift towards, you know, earlier stage investments, development, bringing all of that development pipeline forward, as opposed to just focusing on kind of like cash yielding investment opportunities. I think that is a very exciting area, and it's global. The technologies are obviously both wind and solar. The LCOE has dropped massively, and we can talk about grid parity in many countries now. So some of the question marks that we had again 10 or 15 years ago have dissipated, and there are also very exciting things happening on, you know, new technologies evolving or maturing quickly. Offshore wind, which you mentioned as well, will be the fastest growing, you know, let's say mainstream renewable energy technology for the next 2 decades, and is just about to go global in many parts of Asia, the US, but also even South America is a new market. So there is plenty of things happening globally that are very exciting. As I said, you know, each firm has to, you know, find its angle, its way to differentiate itself. In our case, is the energy efficiency distributed generation, but in mainstream renewables is also finding the right pockets of opportunities and the right markets where we can add value. And certainly in mainstream renewables coming at that, I think that on the development earlier stages is kind of like one of the areas where we can see more value.
Great, really interesting. I also wanted to pick up on cogeneration, combined heat and power. And maybe Jim or Thomas, what stage is this at? And is this an interesting opportunity going forward for investors?
Yeah, absolutely. Historically, combined heat and power would have been more associated with fossil fuel generation, with gas and coal. I suppose what you're maybe looking at going forward is more renewables and storage providing that solution, which historically would have been, you know, because obviously the heat and power, the heat was the excess heat that was produced in the generation process. So perhaps moving forward, we're looking at more renewables plus storage as a sort of next generation of that. That would be my view.
We agree. So basically what we've seen over the last decade is that investment in wind and solar, when we meet management teams now, it's much more talking about like storage to make sure that renewable business stays competitive. In addition, it's hydrogen. So a lot of focus is on hydrogen. So what you see is that for a lot of companies, it's doable to like reduce carbon emissions by like 80, 85, 90% to really become like net zero after like 2030, 2035. That will be the challenge. And for that, new technology is needed, as we've said. So we've seen gas-fired facilities are still being used as backup. So you probably will need hydrogen to replace them with like green gas and make sure that net zero is reached in the decade thereafter. So there will be, it's still a few years out. There's a lot of like research being done as we speak. I think there are big projects also in Europe ongoing. But that will be an interesting sector to follow to see how that's going to play out ultimately.
And again, this is for anybody really, but nuclear was obviously at one point seen as one of the worst forms of energy generation, but has that changed now? Where does it fit in terms of the sort of energy sources? How is that perceived?
It's still widely spread among investors. Some are open for it, others are more against it. But especially if you see if you take Biden's ambitions into account by reaching net zero for the utility sector in 2035. I guess if he wants to reach that and he wants to push that through, nuclear is going to play a big role there.
I think a lot of innovation needed. I'm personally just looking again at Germany. As I was grown in the 80s, everyone was against nuclear power. But if you read about new studies, that there are potentially some solutions that could even use the old nuclear waste for new energy production. That's something where investments, but in the innovation first, is needed, and that makes for me a lot of sense. I think it's not at a stage where we take the old nuclear technology and invest into that. I think that's the bias in the investor space is potentially more against than pro, I would say.
If we're thinking constructively, you know, if you look at hydrogen, we know that you can have these various ways of producing hydrogen. So green hydrogen, where you use electrolysis to basically split water into hydrogen and oxygen using renewable energy. You can also use nuclear energy to do that, and it's called pink hydrogen. And you can use that nuclear power to create hydrogen. And I think, maybe that's a solution, and I think we have to be open-minded, and I think policymakers have to be open-minded, because to Thomas's point, to get to zero carbon by mid 2035, it's a real challenge, and it really is going to require innovative solutions and open-minded solutions. So nuclear, to my mind, is likely a part of that.
Jim's remark that politics has to be open-minded, that's especially for Germany, must be a difficult point, because we have an atomic dropout, and to steer around this huge energy vehicle, it's gonna take time if we have the decision on that one. So I think from the regulatory point of view, there needs to be some time to change as well. Also, the change in the technology has to be before there.
I just wanted to pick up a little bit on some of the difference in terms of the regions. I mean, I guess by nature, infrastructure markets appear to be very global, but are there differences that you're seeing, and particularly in this new energy side, between Europe, Asia, North America?
I mean, I think there's very clear differences in between. Let's put it this way. I think the goals now, I think there's a global consensus, but how to achieve those goals and where in the cycle each geography is completely different, right? You cannot talk about China and India, for example, and their needs compared to the US or Europe by any means, and how they achieve them. So there's a global consensus that getting to net zero is really important. But in terms of like how you set the goals and the path to achieve those goals is completely different. In the case of, for example, and also how the economics of each different technology are also completely different, because the resource in different areas of the world is completely different. So you cannot talk about offshore wind in, I don't know, the southern Europe as the same way that you can talk about offshore wind in northern Europe. But however, southern Europe, Iberia, for example, has an amazing solar resource and the lowest LCOE in the whole of Europe, third one in the world. So I think there will be technologies and there will be different regulatory paths forward for each, depending on the geography. I think in the US, with the Biden administration coming on board, there's been obviously a complete shift in the whole policy and a lot more favorable economic conundrum towards renewables and a lot more regulatory support, and we're going to see a lot more growth in the years to come. But even the instruments they choose to utilize to promote renewables, whether they are tax related, whether it's investment tax credit or production tax credits, they have nothing to do with other parts of the world. So I think the instruments are used where each country is in the journey and what are the specific economics of each geography are completely different. But everybody's working towards a common goal, which is the great news. But as I said, using different paths.
Thanks, Alejandro. And Jim, you seem to be agreeing with that as well.
I think that's right, and I think it comes down to psychology as well. It always amuses me that in Europe we are and in the UK now, independently since Brexit, we're very happy to have a carbon tax. We're very happy to have this idea that emissions have to pay. So that sort of stick to beat us with, and psychologically we cope with that. In the US, it has to be a tax credit, and it has to be a sort of carrot, a sort of incentive to invest, a production tax credit or an investment tax credit. And I think, the US would never ever tolerate a carbon tax. So I think it's really interesting the different ways that different governments frame what are effectively kind of cross-subsidy mechanisms from polluters to green energy. But overall, as Alejandro said, the great news is that even China is moving in this direction. So we do have this geographic consensus framed in very different ways for different countries.
Yeah, that's interesting. And just looking around Europe, maybe Alejandro, what are you seeing in terms of, are there more opportunities in areas like, for example, the Nordics, because Nordics, Scotland, where are you seeing the opportunities there?
There's opportunity everywhere, frankly speaking. I mean, I think, like, as I said, this is I've been working in the industry for 15 years, and this is the best time to be in this sector. There's absolutely no doubt. But obviously the opportunities are quite different in between Northern Europe and Southern Europe, or the rest of Europe. And also the situation, in terms of like each country and where they are in the path towards recovery post-COVID is also completely different. So as I said, as a general theme, I will say the funnel for new development, new assets being brought into construction and operations is, we're just going to kind of multiply by 2 times the scale of installed renewables on the power generation side in the next decade. So everybody's cranking up their development teams, development pipelines to get all those megawatts through the system. That creates issues, right? For example, we are not talking just simply about the consensus is there, but there is constraints in terms of human capital. There is constraints in terms of access to grid. There is constraints in the planning processing system of each different country, and each regulator is now trying to sort those issues out to facilitate the energy transition. Now in Northern Europe, I think it's very clear, and I'm talking about Northern Europe, I'm talking the Nordics, Germany, the UK, etc. I think the economics of wind generation are very, very favorable in both offshore and onshore, and we see a lot of activity in that sector, or in that technology in particular, very big, promising, ambitious plans where there is new rounds of offshore wind being auctioned in Norway, Sweden becoming an important country in that technology as well, or the UK. But then in Southern Europe, on the other hand, in terms of new technologies, new capacity being brought into the mix, I think certainly solar, the economics of solar, for example, in Iberia and Italy and Greece are absolutely amazing, and we are talking about grid parity levels with fossil fuels and taking a very quick ramp up. So I think there's opportunities everywhere. I also see some cross collaboration across different countries, which is really helpful to see. For example, talking about energy islands in Northern Europe and interconnection, increased interconnection, so that obviously we are not overbuilding in one country, so that we have excess supply of electricity, etc. So there's lots of activity across the whole of Europe. But obviously, and I think it does make sense this way, in a way, in a world without subsidies or without the requirement of regulatory support, I think the technologies that will prevail are those that have a more better economic viability, and that's what we're seeing. So in a very simple way, wind in the Nordics and solar in Southern Europe, although solar is reducing capex cost very rapidly and is also penetrating in Northern Europe.
Yeah, that's really interesting. I think that reduction in terms of the overall cost, so that you've got that economic driver there also working as well as the other drivers, is a really interesting part. And just a question as well, because obviously there are areas like carbon capture and storage. Are these seen as part of this new, the other side of the new energy sector? Are those areas that are an investment opportunity and areas that you're also looking at?
I'm happy to comment on this as well. Yeah, absolutely. No, carbon capture, when we need to decarbonize industry, obviously there are industrial processes. Hydrogen, by the way, is a pre-existing industry. I think it's like a 5 trillion, I think it's, don't quote me on this, but it's already a massive industry in terms of the whole economic value in industrial processes, for example, manufacturing of steel. And so it's a very quick way of decarbonizing is replacing gray hydrogen by green hydrogen. Obviously, that is a cost implication, and it potentially changes to industrial processes to make it economically viable. But decarbonizing in the industry is the fourth leg, leaving aside power generation, transport, and heat. And certainly, as you were mentioning, Richard, carbon capture storage for industries that are particularly more difficult to decarbonize is a very clear way forward. There is a very promising, I think there's 4 pilot projects in the UK for carbon capture storage. There's a huge amount of industry cross collaboration to make them happen, and the technologies are becoming widely available. The economics are, I guess, like tough today, but because we are talking about very big industrial customers and there's like this drive to decarbonize their supply chain, I think we see a level of attention that wasn't there before. Now is, even if the economics do not necessarily stack up, there is a will to try to make it work, and I think that has massively changed over the last 10 years.
And so this is the kind of area where it's really going to need government support, I suppose, in order to be able to drive change in that particular part of the industry. Correct.
And there's obviously work to do about health and safety and as well as the economic end of the investment. But certainly those are the areas where there is there will be a need of some form of government support to facilitate that transition. And I mean, look, the same way that renewables require support at the beginning of the in the let's say late 90s, early 2000s to until you get to the economies of scale and you get to the levels of cost reduction that make it economically viable and in an independent way. There are certain areas that are harder to decarbonize, and certainly manufacturing industry is one of them. But also we see customers of those industries and those manufacturing facilities lending a hand to say, well, I also want to be green. I want to decarbonize my supply chain. So am I willing to pay more or to contribute in a slightly different way or to facilitate the energy transition? And that certainly wasn't there like 10 years ago. So I think that's an important area as well.
Great. We've only got a couple of minutes left, so I just wanted to just pick up a last kind of thought from everybody, which is, I guess, if we're looking at opportunities, key trends in the market, what do we see as I suppose, the key opportunity? You can either look now or in the next 5 years, however you see that. But let's start with you, Thomas, from PwC's perspective. I suppose, where are you seeing the opportunities here?
Well, as we heard, there are so many out there. I'm personally a big fan of hydrogen, so that's where risk return is in a good, let's say, situation. So that's one key thing I would focus on. But it's only one. There are a handful of others.
Great, thanks. And Thomas, from Kempen's point of view, where are you seeing the big opportunities going forward?
Where we currently see the opportunities, and then we're talking in the next few years, so not like the next decade. We're mainly focusing on like the renewable build out plus the grid investments.
Great, super. Thanks very much. Sophia, what's your kind of view on either the opportunities or the key trends as you're seeing them?
Yeah, we talked a lot today about decarbonization, but we have to also think about digitization and decentralization, and that's where some issues I would say are a great opportunity again.
Great. It sounds as though we need to have another session just on that, Sophia. And Alejandro.
Yeah, for me, look, it's the next decade is all going to be end customer driven. So whatever we're doing to decarbonize the economy, it's going to be driven by what the end customer or the end user wants, and therefore we need to start focusing on opportunities that start with the customer needs. So whether it's in manufacturing or whether it's retail or technology companies with high usage of electricity or energy like data centers, etc. So creating innovative clean energy solutions that deliver economically power or decarbonize their operations is the way forward.
Great, super. And last but very not least, Jim.
Yeah, absolutely. Don't forget grid assets, transmission, distribution grid assets. Absolutely crucial plumbing to the energy transition. And what we always say to investors is, if you're thinking about electric vehicles, we don't know who the winners are going to be in terms of the manufacturers, whether it's going to be Tesla or Volkswagen or the Chinese manufacturers. We don't know which battery technologies will ultimately be the winners. What we do know is that nobody's going to build a new electricity distribution grid in London or New York or Frankfurt. The investment will come in the existing grid. And I think these sort of dull, boring utility assets are actually incredibly exciting for the energy transition story.
Great, really interesting to see how there's been that change of perspective, and also that mirrors in some ways actually the change of view in logistics as well, which, up and, sort of a while ago was counted as really dull and boring and nobody wanted to talk about. And now, because of changes in terms of innovation and technology, suddenly that's a really interesting and exciting area. Great to get your insights on this market. It's a new area for me, and so I'm really interested to learn more about this, and we'll certainly be doing more around this topic especially. Thanks very much to all of the speakers. Thank you for joining us and for your questions. We'll make this available on demand so that then you can share that, and you can also access the both the presentations on the website. Thanks very much for joining us, and look forward to seeing you in the next one. Thanks very much, everybody.
Thank you.